Thanks, Sandy. Okay, so we're all here. I'm just going to work out where I've got to look at. Look, my name's Gordon Noble. I'm the Director of Investments at the Association of Superannuation Funds of Australia, ASFA, and we are the peak industry body for the sector. And that's a sector, and I'll go into a little bit of detail, that you all in this room are a part of. It ranges from the person who runs their own self-managed super fund, the mum and dad investor, through to the $70-80 billion fund, and everything in between, the retail sector, government funds, industry funds, etc. So what I want to do in the next 10 minutes is to really talk about superannuation, because a fundamental aspect of having any investment from the superannuation sector is really the need to have some shared understanding, so that the impact community, if you're to call it that, understands what superannuation funds are looking for, what their constraints are, what the opportunity is. And I think it's only through that kind of shared understanding will you get the kind of conversations that can result in investment in the future. At the moment, just as background, impact investment is not a core part of our investment universe, and that doesn't surprise anyone in this room. It is a growing investment universe overseas. It's become, if you like, there is a developing argument that it becomes an asset class overseas, but here in Australia, the number of super funds that have made investments is there's only a handful that have actually made any investments that you could describe in the traditional form of impact investment. If you take a wider perspective, there's a whole lot of investments that have an economic and social impact that super funds invest in. I want to just give you a context of why super funds will be interested in the impact investment landscape in the future, even if they're not as interested as they should be today. And there's really a couple of drivers of that. The first one is, just to give you some background, the superannuation sector is 1.6 trillion at the moment. So of that 2.5 trillion that I think Danny mentioned was the investable universe here in Australia, 1.6 trillion of that is currently sitting in superannuation funds. That is scheduled to grow, according to Treasury figures, by 2030 to $6 trillion. Now, the growth of superannuation, which comes from the 9%, which will go to 12%, the compulsory superannuation contributions, the growth of superannuation itself, when it becomes a $6 trillion system in the future, is one of the reasons why super funds will need to look at investments that are outside their core areas that they're investing now. There's a couple of reasons why. One, they'll look for diversification. You just can't simply put all the money in the same pot, and that has implications in terms of the structure of the ASX, where a lot of the money flows at the moment. So super funds will be looking for investment opportunities that diversify their portfolio. But the second reason, and perhaps it is the most significant reason, is that as the system grows, and remember, compulsory super has only been around for 20 years, as superannuation grows to that $2, $3, $4, $5 trillion, it will undoubtedly attract much more attention of government. And in that context, we are already having lots of conversations when we go to Canberra, Treasury and others around, what does superannuation do for the tax concessions that it gets? And those tax concessions are around about $30 billion every year, so it's quite a significant amount of money. But the reason I believe that government will be asking super a whole lot more tougher questions going forward is because government itself won't have the same ability to run the programs to solve social and economic problems that it has had the ability to do in the last 20 years. And this is something that I think faces every Western country that has had the baby booms that came out of the end of the Second World War. We've had, and we focus a lot on the demographic issues in our sector, but we've had the first baby boomers retiring, hitting 65 in the last couple of years. What we are facing here in Australia, and other Western countries face the same, is that in the next 10, 20 years, we will have the the baby boomers moving to retirement. By the end of this decade, you'll start to see a fundamental shift in the composition of the workforce. More people will be starting to move out of the workforce into permanent retirement, and the burden that will be on those who are in work will be supporting more people who are in retirement. And that's not going to shift anytime soon. The forces, the demographic forces that we've known about for many, many decades are hitting us now. And by the end of those demographic forces, I think you'll see a fundamental shift in the structure of the Australian economy, in the workforce participation. But that's going to impact governments, and it's going to impact their budgets. Their ability to run budget surplus is going to get harder. If you have a look at what the Grattan Institute, who are the leading, if you like, think tank in Australia, is saying, we're facing at the moment 60 billion annual government deficits at a federal level just with the current policy settings. So what we think is when this transition starts to happen, and we're only seeing the start of it right now, you'll start to see governments look around, and they'll look around and they'll see this one great big pot, and that's the pot of superannuation pool of assets. It won't be the 1.6 trillion it is now. It'll be the 2, 3, 4, 5, $6 trillion, and we think that is going to mean that there'll be a lot more focus of government on how the superannuation assets can achieve economic and social objectives. Now that's where we're going, it's not where we are at the moment. So the issues in terms of talking to superannuation funds at the moment, for anyone in this room has had the experience of talking to superannuation funds with proposals, it's not easy, and it's not likely to get easier in the short term. But what I wanted to do is to set in a little bit of background what it is that superannuation funds are likely to look at, and what are the things that, if we can, if you like, create a greater shared understanding between us, represents some hope that you start to get some investments. So the first thing is how superannuation funds invest. The key thing is to understand the way a superannuation portfolio is built. So if you are talking to a superannuation fund about investment, you've got to understand exactly where they would put your proposal in terms of what part of their investment portfolio. So super funds invest everything from fixed interest defensive investments through to our growth investments, infrastructure, Australian equities, etc. So you've got to decide fundamentally, is your proposal a growth investment or is it a defensive investment? One of the things that is needed for super funds is a whole lot of governance. They want to see that you've got the governance around what you're proposing, your ability to manage what you're saying you're going to do, and you've got the ability to demonstrate you've got some management capability to deliver. In terms of the things that often when we talk at super funds, there's a view that a super fund would be attracted to a 25% return or a venture capital-like return. And surprisingly, particularly post the global financial crisis, that's actually not what super funds are looking for. What funds are often looking for is low volatility and solid returns. Not shoot the lights out returns, solid returns. And one of the issues around volatility, and volatility from a super fund perspective, simply means how much does the value of what you invest in go up and down. And one of the critical things for a super fund is the ability to be able to put a valuation on what it is that you have created in terms of an investment proposition. And that's one of the fundamental constraints I think that we need to work through. Valuing an investment, there's a cost that's associated with that. And that also then brings us to one of our constraints, which is scale. The truth is, and I noted the conversation that we had before the luncheon, but the truth is that superannuation funds are better investing in scale rather than small opportunities. The opportunities that are less than $1 million, I think it's unlikely that you'll have a superannuation fund that'll have the interest in that. In fact, the larger the investment is, the more likely that a superannuation fund can basically use its due diligence process. The more that due diligence process is spread over a larger amount of capital, the more likely a super fund is going to look at it as an investment opportunity. The other side is, if you're talking to a super fund, you do need to talk their language. Now, the social impact of what can be delivered is important. It's important for a superannuation fund to be able to communicate that it is investing in things that make a difference. That is part of its communication with its members, something that will get much more important in the future. But the fundamental conversation is about investment returns. A superannuation fund is not going to make an investment unless there is a clear proposition around what the investment return is. In that regard, the two words that you need to bring to the table are correlation and diversification. And the opportunity that the impact investments represent is diversification from what super funds normally do, which is to invest principally in listed markets, and correlation. Now, what correlation is in investment terms is simply meaning that what happens in the capital markets, does the investment in a impact investment, does that react in exactly the same way? And if it doesn't, that's a benefit for the super fund, because what super funds are looking for is to build a broad base of diversified assets. So one of the problems post-GFC is the whole world effectively reacts to events in the US, and everything that is unitised goes up and down in the same way. The more that you have an investment that doesn't do that, that is something that you need to communicate, and communicate it to the super fund in their terms. So I guess I've come across it's about the 10 minutes just to capture what the challenges are. What we would see is that we're really at the early days in terms of creating an ecosystem around investment of superannuation funds and impact investment. It's not going to be an easy journey. One of the things that we've done is we've established a working group with one of our sister associations, the Responsible Investment Association. We've established an impact investment working group that's being chaired by Tim McCready, who's the Chief Investment Officer at Christian Super. And what we want there is to create the place where we can have a discussion about not about the deals that come to the table, but what are the structure that we need in order to have a conversation in the first place. What is the template that we need that we can then communicate to impact investors? These are the things that we're going to need. So we see that there are going to be opportunities coming forward, but it's going to take some time before we get the kind of ecosystem where we could genuinely say that we've got a market. At the moment, I think we've got the side that's creating the supply of opportunities. We've yet to create the demand side, and I think that's the opportunity.